Welcome everyone and to this session. And the topic is more on the corporate governance side, but I'm sure with a lot of accounting perspectives, but is about how the chair and the CEO are talking, at least their narratives are consistent with each other, and or not, or lack of the consistency, and how does this affect firm performance? So it's a typical, let's say, governance, corporate governance. And another thing I think the paper is interesting is that they use context analysis to derive some data, some indicators, which is now very popular. And Tulu is one of our experts in this area. So Tulu is one of our colleagues from our department, finance and management. We have been colleagues for quite a long time, Tulu, and you remember me and vice versa when we first came. So Tulu is taking care of, has contributed significantly in terms of our accounting and finance education program, BSc, and also master's level. So, and as you can see that I just checked with Tulu is one of our very few chartered accountants in this department, and he has done a variety of research, and that covers corporate governance, covers accounting reporting, and other related issues. And he has published in different journals. And he actually, if you can see his education background, he got a lot of degrees that I do not go through them one by one, but very many, even masters, I think double or triple masters. So I really appreciate your time, Tulu, and your support to the seminar, to CGF Seminar, and I look forward to your presentation today. And as I already agreed with Tulu, when there are some questions in between, I'm happy to allow people to ask a question, and Tulu is also happy to respond. So this is how we interact with each other and to enhance the efficiency of the discussion. Okay, so Tulu, I gave the floor to you, and it's up to you how you organize your presentation.
Yes, thank you, Ong, and thank you everyone for the opportunity to present my working paper on monitoring and cohesion. This paper is an ongoing paper, so I will appreciate a lot of feedback from the audience in order to improve the quality of the paper. It is a bridge between corporate governance and corporate disclosure. It also introduces the new method of measuring the similarities between narratives. I will introduce the method as we go on. This is the roadmap. I will briefly look at the background of the paper and the motivation for this paper. In case some of you may want to leave before the end of the presentation, I will quickly talk on the contributions. Then I go to the literature review and the three hypotheses that I'm testing in this paper. And then I'll move forward to the methodology, which serves as the framework for this study. I will then look at the results, then I conclude and also provide opportunity for questions and response from the audience. Narrative disclosures in annual reports, as we all agree, plays an important role in corporate communication. For example, in signaling future or current performance and strategy of the organization. A typical annual report, for example, will consist of not less than 2/3 of narratives, in addition to the numbers and figures that we all are aware of. So if narratives are important for corporate communication, then we should start looking at the signals that these narratives can give to us. Currently, prior research have looked at the importance of corporate narratives in the sense that it signals information to investors, and it also affects capital market variables, for example, capital market reaction to these narratives. Most textual disclosures focus on individual narratives. For example, you talk of CEO letters, you talk of MD&A. These are usually studied in isolation. In addition, the attributes are studied in isolation. For example, the readability of the corporate narrative, the tone, and the sentiment. However, we know that the corporate narrative is a combination of the narratives by different leaders within the organization, most especially the chair and the CEO. The question, therefore, is that do these corporate narratives reflect the governance relationship between the chair, who is responsible for board oversight, and the chief executive officer, who is responsible for day-to-day management of the organization? So that is the main question that we want to tackle in this particular study. The study relies on a number of theoretical backgrounds. The first is the issue of agency theory. Governance and framework around the world relies on the separation of management from monitoring. In this case, the chief executive, as I earlier said, is responsible for the day-to-day management of the organization. Effective monitoring is the responsibility of the board of directors, shared by the chairman or the chairperson. So we see that sometimes there may be a conflict between monitoring activities of corporate governance and day-to-day management of the organization. And that is where agency issues can arise. There is also the theory relating to stewardship. Contrary to the perspective of agency theory, the stewardship theory believes that management and the board of directors should work hand in hand in order to be able to maintain good working conditions and improve the performance of the business. So contrary to agency theory, which believes that executives, if they are not monitored, have the tendency to manipulate the accounts or act in a way that is not consistent with the shareholders' interest. The stewardship theory believes that there is an alignment between the board of directors and the executive, which promotes positive firm performance. Another theory that we rely on in this paper is the role theory, which says that the chair and CEO occupy distinct governance roles. And as a result of this, there may be conflicts between these roles, such that these conflicts will appear not only in firm performance, but in the way in which each leader, the chairman or the CEO, communicates to shareholders or the public. So we want to see which of these theories is actually signaled by the corporate narratives in the annual report. So is it agency that dominates, or the stewardship theory, or perhaps there's a story to tell in between these strands of theories. If we go back to the literature, we see that the relationship between the chair and the CEO has been studied in a number of ways. For example, you talk of CEO chair duality. You also talk of the age gap or the prestige gap between the CEO and the chairman. But the current literature is keeping the issue of communication between the chairman and the CEO. So what signals can we get from this communication between these two leaders? So the central question of the research is to look at the chairman and the CEO relationship from the perspective of corporate governance and corporate disclosure. So stated in a more succinct way, we want to answer this question: does leadership narrative alignment matter? Whether the convergence of communication between the two prominent leaders within the organization matter for firm performance. We've only chosen firm performance as a signal. We could also look at other corporate outcomes. But the belief is that if it matters for firm performance, perhaps it will matter for other corporate outcomes, such as cost of capital or cost of debt, which is something that we may want to study in the future. So the study examines whether semantic similarity, we measure the convergence between the narrative of the chair and the CEO using semantic similarity, a concept that I will present later in the course of this presentation. Specifically, we look at whether there is the similarity between the chair and the CEO narrative signals the current level of performance. So I draw on agency theories, stewardship, and role theories to examine this question. In terms of methodology, I also use computational text analysis, which relies a little bit on machine learning to derive a measure for similarity. In terms of contribution, as earlier mentioned, prior research examines textual properties of individual corporate disclosure. In this particular study, we are looking at different corporate disclosures within the annual report, the chairman's letters to shareholders, as well as the CEO letters to shareholders. We introduce CEO chairman narrative similarity into the literature. Two, we also contribute to corporate governance research by looking at the relationship between the CEO and the chair. As I said earlier on, a number of studies have looked at the corporate dynamics between the CEO and the chair. For example, the CEO power, whether it affects the performance of the organization or not. We are looking at a different dimension, whether the communication overlap between the chairman and the CEO has implication for performance. So we show that leadership communication alignment can reveal corporate dynamics between monitoring and cohesion with strategic leadership. We also contribute to strategic leadership literature by looking at the interaction among top leaders within the organization. Different studies have looked at demographic similarities as well as executive teams similarities. We are looking at the language, the similarities in the language between these leaders. So we go beyond demographic similarity to examine communication-based alignment between corporate leaders. Finally, in terms of methodology, we introduce natural language processing techniques to the measurements of corporate narrative alignments between leaders within the organization. Here we apply TF-IDF representation in order to measure the similarity. In the next few slides, I will introduce the concept of TI-IDF and how we apply it in this particular study. So we quantify the semantic similarity between chair and the CEO narratives. Therefore, we demonstrate how computational text analysis can be used to study governance dynamics within the leadership tiers. In terms of the hypothesis, we specify 3 hypotheses in this study. The first relates to the tension between the chairman and the CEO. Relying on the agency theory, which I earlier presented, we recognize that there may be a tension between the monitoring function of the board of directors represented by the chair and the alignment or cohesion possibility signaled by the stewardship theory. So if independent monitoring, if independent monitoring supersedes the stewardship, we imply that ensuring management, we imply that the relationship between management and the board of directors represented by the chair will be positive in terms of independent monitoring by the board. On the other hand, we also expect a positive relationship if strategic cohesion represented by the stewardship theory supersedes that of agency. So there is a tension. We could expect a positive relationship if monitoring supersedes. We can also expect a positive relationship if cohesion or alignment between the board of directors supersede. So the question, therefore, is that we should be able to establish a middle, which we call the danger point, where neither monitoring or cohesion or alignment is in operation. And that is what we want to establish using this particular methodology. In most organizations or corporate governance, there is a separation between the CEO and the chair. As I said, this creates structural tension between monitoring and leadership. We can refer to this the papers by Farmer and Jensen relating to agency theory. We also note that the role differential between the chairman and the CEO has implication for performance. For example, effective governance requires separating decision management by the managers and the decision control by the board. When monitoring is independent, board directors maintain distinctive perspective. So if they maintain distinctive perspective, under the condition that monitoring is independent, we expect, therefore, that the language that they use to communicate will be different for each chairman and CEO. The implication of this is that low similarity between chairman and CEO may signal strong monitoring independence. It may also signal low agency cost or greater governance and credibility. Therefore, we expect that stronger monitoring improve firms' outcome, for example, firm performance. However, the role theory suggests that there may be a conflict between the directors and the chair. If there is a conflict between the directors and the chair, then the company is not likely to work optimally. So we could have a situation where performance will be affected. The question is that can we get the signal from corporate narratives? The stewardship theory, on the other hand, suggests that we could have a positive relationship if the CEO and the chairman are working as if they are a team. In line with this discussion, this is the summary of what we expect. For low similarity, in terms of governance implication, we expect strong monitoring and high performance. For high similarity, we expect strategic cohesion in line with the stewardship theory, and we also expect high performance. In between these two continuum, we expect that moderate similarity suggests role ambiguity and therefore low performance. We conclude, therefore, and reach our first hypothesis, suggesting that chair CEO narrative similarities exhibit a U-shaped relationship with firm performance. So we have a point where performance is high at low similarity, another point at which performance is high at high similarity, and there is a middle where we cannot really say what is happening, the danger zone as we refer to it.
And Tulu, can I ask you to clarify one thing, and that is the application of agency theory to the relationship between the chair and the CEO. If I'm the CEO, you are the chair, what are the agency problems between us?
In terms of agency theory, the chair is expected to mitigate agency problem by monitoring.
So the agency problem is the problem between the manager and the shareholders.
It is the problem between the managers and the shareholders, which the chairman is expected to mitigate. But the chairman can only mitigate this problem if the chairman is independent. If the chairman is not captured. I use the chairman here.
You mean the CEO is not captured, or vice versa? Normally, we see CEO is very often captured by the board or by the chair. So if you are the chair, when you appoint a CEO, you design the incentive package to the CEO. You can capture the CEO so that the CEO will make the decision aligning with your decision. So that's what, so I'm thinking about what are the agency problems between us. You say it's the CEO who is responsible to monitor the manager, the CEO, so that
No. It's the chair that is no. It is the chair that is responsible to monitor the CEO. The chair acts on behalf of the board. The chair acts on behalf of the board.
Okay.
Okay.
So you assume the chair is always on behalf of the shareholders. That's the assumption.
Theoretically, the chair is supposed to act on behalf of the shareholder. Whether that happens in reality is another question. Okay? Mm-hmm. Especially when the CEO has a lot of power. For example, perhaps the CEO is involved in the appointment of a significant number of the board of directors.
Yeah. Okay, fine. So that's the assumption. So still there is agency issues here because the chair is representing the shareholders. And so in that sense, there is, I can see the agency. Yeah, sorry about that. And are you here in hypothesis, right?
Yeah. So the first hypothesis that we intend to test is the U-shaped hypothesis, that the CEO narrative similarity exhibits a U-shaped relationship with performance. And this is derived from the three theories that I presented, okay? Mm-hmm. At the expense of repeating myself, we expect high performance, okay, at low similarity when there is independent monitoring, in which case the language between the chairman and the CEO differs. Mm-hmm. Consistent with the stewardship theory, where there is alignment between the chairman and the CEO, we also expect high performance. But where we cannot distinguish, okay, where there is moderate similarity between the language used by the chairman and the CEO, we expect low performance. We also looked at the moderating effect of chairman's CEO age gap. A number of studies have looked at the demographic impact of the chair and the CEO characteristics on performance or corporate outcomes. So we wanted to look whether the relationship, the U-shaped relationship that we uncovered in this particular paper is moderated by this particular variable, chairman CEO age gap. Mm-hmm. We suggest that when the age gap is large, the generational and experience distance between the chair and the CEO will affect board oversight and executive leadership. As a result of this, we conclude that the CEO chair age gap will moderate the relationship between corporate narrative similarity and firm performance. We expect that this will be stronger when the age gap between the chair and the CEO is larger, because age also represents a number of corporate governance variables, for example, prestige, experience, education, etc. So we suspect that if the age gap is large, then performance will be stronger. We also looked at the possibility that the CEO power may affect the relationship that we uncover. For example, if the CEO has captured the board of directors, it is possible that the language in the CEO letters and the chairman letter will not differ, because for example, they are speaking from the same in-book. and the in-book is written by the CEO. So if the CEO has greater power, then this may affect the relationship between corporate narrative similarity and firm performance. We argued that this would be weaker in the presence of high CEO power. This is the econometrics model that we estimated. We wanted to look at the relationship between firm performance measured by return on assets and similarities. Consistent with the U-shaped relationship that we specified, we also use the quadratic form of a similarity measure. The moderating effects are captured by the CEO power and the CEO chair H gap. In terms of methodology, we use FTSE 350 non-financial firms for the period 2004 to 2002. We excluded firms for which the office of the chair and CEO are combined, because in that case, the chairman's letter will be the same as the CEO letters. Therefore, we will not be able to get the similarities that we intend to measure. We use accounting data from Workspace, formerly Icon. We collected CEO and chairman's demographic variables and board governance data from Board X. We extracted the letters using Python. When we combine the CEO and chairman's letter with the accounting data, we arrived at 2,340 observations. This is the definition of variables that we use in this particular study. Most of the variables are known to you. I'll just say a little bit about the measurement of CEO power and the age gap. In terms of CEO power, we capture this using an index consisting of CEO tenure, or whether the CEO is internally hired or the CEO is the founder of the company. We suspect that these variables will grant the CEO more power relative to the chair or the board of directors. In terms of age group, we assume, in line with other studies, that the generational group is determined by a difference of 20 years. So if the chairman is older than the CEO and the difference in their age is at least 20 years, we assign the value of 1. Otherwise, we assign the value of 0 to capture the CEO chair age gap. We also control for a number of variables relating to the firm characteristics, corporate governance variables. I'm going to look at the measurement of cosine similarity because that is the thrust of this paper. As I said, we extracted CEO letters and the chairman's letter from annual report. Then we converted these narratives to numbers by performing a number of machine learning pre-processing. First, we lowercase all the words in the letters. We converted all the words to lowercase. We also removed stop words. We removed stop words and function words because we wanted to look at semantic similarity. So we removed stop words such as D, I, okay? We also remove function words. which implies that what we are looking at are the content words, those words that have meanings. Those are the words that we retained. Then we did a number of transformations. We did a number of transformations, and we arrived at clean output for the document. The next stage, we converted the text to numbers using vector representation. This is your TI-IDF vectorization. Time frequency, inverse document, and frequency. So we collected the content words as if they are bag of words. Then we weighted the content words using the IDF, which gives greater weight to rare words. Those rare words we assume are the words that define the particular document. Once we have created the vectors for the chairman's letters and the CEO letters, we calculated the cosine formula. I give an example. For example, if you have profit as a word, a content word in the chairman's letter, and you have similar words, okay? But in terms of the CEO letter, the CEO uses earnings. We can use our cosine formula to look at the similarities between the narratives in the chairman's letter and the CEO letters, even if they are using different words. We capture the similarities by looking at the angle between these words. The smaller the angle, the higher the similarity score, and the higher the similarity between the chairman's narrative and the CEO narrative. This measure has been used in top accounting and finance journals. So this is what we use to capture the semantic similarity between the chairman's letter and the CEO letter. This is the distribution of the cosine similarity between the CEO letters and the chair's letters. One thing is evident here. We can see the skewness of the distribution, okay? One, this may affect our econometrics estimation. But there are 2 points that I want to bring out here. One is the fact that contrary to what is expected, that many of these letters are scripted. We find out that the similarities between the chairman and the CEO letters is not that high. In fact, most of these letters are below, many of the letters are below 0.5. By the way, the range of this cosine similarity is between -1 and 1. But for narratives, we do not expect negative values, so we expect between 0 and 1. So if we look at this distribution, even though we can see the skewness, which may affect our estimation, we can also conclude from here that in fact, the CEO letters are not as, the CEO and chairman's letter are not as scripted as we expect them to be. So this usually is one of the limitations of studying narratives, that these narratives are not actually written by the chairman. They may be written by the CEO, and they may be written, in fact, by a public relations office. What this is telling us is that that may not be the case, because we can see that the similarity is low. The vertical line you see there is the turning point. I'm going to get to that later. It is the turning point where the similarity between the chairman and the CEO letter becomes positive, okay, for alignment. And this is around 0.8, 0.58. So at 0.58, even though there has been a reduction, in performance, we expect that performance starts to increase relative to similarity at 0.8. I'm going to show this when I present the econometric estimation of the result. This is the descriptive statistics. We see there is a lot of variation in our measure of cosine similarity, or the similarity between the chairman's narrative and the CEO narrative. The other control variables are also presented. The text is a little bit tiny here, but the importance of this correlation matrix is to show that the regression results that I'm going to present later does not suffer from multicollinearity. In fact, we see that the correlation between the variables, except for the cosine similarity and the square of cosine similarity, the correlation is very minimal. Okay, it is within the expected threshold. So we don't expect that multicollinearity will be an issue in this particular study. And this is our first set of results. Consistent with our first hypothesis, we see that there is a negative relationship between cosine similarity and firm performance, which is consistent with the theory, the agency theory, that monetary independence by the chairman are signaled by cosine similarity results in high firm performance. Sorry, let me take that again. The negative sign, okay, suggests that there is a negative relationship between similarity or cosine similarity and performance. But when we look at the square form of cosine similarity, we say that this changes to a positive relationship between similarity of chairman and CEO letters and performance. So the first model there confirms our first hypothesis. It confirms our first hypothesis, and it also suggests a U-shape relationship. The next model, we look at the moderating impact of age gap between the chair and the CEO. Consistent with our expectation, we report a negative relationship for CEO chair gap, age gap, and cosine similarity, and a positive one when we take the square form. However, for our CEO power interacting with the similarity score, we see that this relationship does not hold, implying that the CEO power does not moderate the relationship between cosine similarity and firm performance. So at the conclusion from this table is that only chair CEO gap moderates the relationship between the narrative similarity and firm performance. The last model, we incorporated all the variables, including the moderating effect of gap, age gap, as well as the CO power. Again, we see that the age gap dominates CO power in this particular model. We did additional analysis. Instead of using return on assets as a dependent variable, we adjusted for industry effects. We adjusted for industry effects by subtracting the main industry return on asset from the firm return on assets. We established the same relationship as in the baseline models. So we conclude, therefore, that this relationship is not driven by the measure of dependent variable that we used. We also tested whether this U-shaped relationship is valid. We used the U-test command in Stata. The expectation is that if the U-shape that we have uncovered in this paper, if it is valid, then the turning point will be within the range of our cosine similarity measure. And that is what we got here. When we measure the turning point, we got this to be 0.58, which is within the range of 0.001 and 1 that we discovered in the study. We also did a test of hypothesis where H1 is the U-shape and HO is the monotone or inverse U-shape. We concluded that, in fact, the relationship between corporate narratives and firm performance is U-shape. T value 2.7, the T value 2.71, P value very low. So again, we uncovered the quadratic relationship between narrative and firm performance measured by a return on assets. Again, we try to look at the relationship between these variables by looking at the predicted return on assets and the cosine similarity that we uncovered. We looked at this from the point of view of the two moderating variables that we use, age gap and CO power. Okay, from the slide, we show that, in fact, age gap moderates the relationship between firm performance and corporate similarity. We also uncovered the U-shape. As you can see from this particular graph, there is a shift, okay, in the shape of the graph when we use age gap less than 20 and age gap greater than 20, greater or equal to 20, suggesting that, in fact, chairman's age similarity moderate the relationship between performance and corporate narratives. Again, we can see from here that the turning point is around 0.8, which is within the range that we already uncovered in the descriptive statistics. So this proves to a very large extent that, in fact, this relationship is U-shaped and it is moderated by the age gap between the chairman and the CEO. We did the same for CO power to see whether this relationship is moderated by CO power. We see that this is not the case. As we see, the shape is the same and the turning point is the same for whether we use CO power P25, okay, percentile 25, or ICO power percentile 75, or we use mean CO power, we see that the CO power does not moderate the relationship between a similar corporate narrative similarity and firm performance. Our cosine similarity is based on the angular distance between what's in the corporate narratives. We also look at another way of representing our data using set theorem. Okay, the idea is for us to look at whether the words used in the CO letter are the same as the words used in the chairman's letter. Here we apply the so-called dyad similarity, which is the intersection of the words in the chairman's letter and the CEO letter divided by the total words in both letters. We expect this to be between 0 and 1, where 0 implies no overlap and 1 implies identical vocabulary sets. So if they are using the same vocabulary sets, okay, we expect that the similarities will be high, otherwise it will be low. We repeated our analysis using the dyad similarity score to measure the corporate narrative similarity, and we related this again to return on assets. We related it to return on assets, consistent with what we presented earlier on. We see a negative relationship between similarity as measured by dyad lexical score and return on assets. When we take the square of this similarity, we also report a positive relationship, which is consistent with the U-shaped relationship that we already uncovered. The same results we report for cosine similarities are also consistent with those for dyad similarity. We conclude, therefore, that there is a signal we can deduce by studying the similarities between the words used by the CEO and that used by the chairman and relate this to performance. We repeated the same exercise for industry adjusted operating performance. The same measure for industry adjusted operating performance, and we got the same results as we did for cosine similarity. In terms of conclusion, we conclude that there is a robust U-shaped relationship between CEO chair narrative similarity and firm performance. Although the purpose of this study is not to establish a causation, what we are trying to establish is a correlation, an association between the CEO chairman similarity and firm outcome, in this case, firm performance. Low similarities may signal strong monitoring, low differentiation, and therefore likely high performance. High similarity may signal strategic cohesion or unified leadership consistent with the stewardship theory, and will result in high performance. The moderate similarity between these narratives may signal role ambiguity, where we cannot distinguish between the role of the chairman and the role of the CEO. There is a tension there, and it could lead to low performance. We are cognizant of the limitations of some of the limitations of this particular study, one of which is the fact that even though these letters are referred to as CEO letters or chairman's letters, one cannot be too sure who wrote the letters. It could be public relations officers, as I've stated at the beginning of this presentation. So it is scripted. It goes through a lot of writing and moderation. To that extent, we may not be able to conclude that this, in fact, the letters are in fact written by the chairman and the CEO. Another limitation which we'll look at before finalizing this paper relates to the representation of these words. We have used vector representation in terms of cosine formula. We have also used set representation in terms of dyad similarity index. Another possibility is for us to use word embedding, okay, such that similar words with the same meanings, we can capture them, okay. And this requires us to use, for example, word to vec representation of involved sentiments and a sentence transformation, which is the next step that we want to look at. So this is the end of the presentation, and I'm happy to take questions from the audience.
Yeah, thank you very much, Tolu. It is very clear. We heard the motivation, and we heard the underlying theories, the multiple, and then we saw the process of your econometrics and very clear conclusion. I already see Jaideep's hand, but Jaideep, allow me to ask one. Tolu, if you look at your conclusion here, you say you found a robustness U shapes, and then lower similarity lead to higher performance. Also, higher similarity leads to higher performance.
Yeah.
Is this U shape?
Yeah, it is.
Yeah, but so when the similarity is lower, according to your conclusion, when the similarity is lower, that will lead to higher performance. But if it is U, it should be when the similarity is lower, the performance is lower, so that you can have a higher similarity, which leads to higher performance, and that will be a U shape. So my question is, how do I make the connection between your item, your line 2, line 3, and this U shape?
The U shape, okay? So there are two optimal points. The implication of U shape is that there are two optimal points, okay? So the left, which is low similarity, okay, performance is high.
Okay, left, yeah.
Yeah, consistent with agency theory.
So where do you have two thresholds here? When you have a U shape, you only have one threshold, right?
No, you only have one, okay, which is the turning point, 0.8 that I will cover, okay? But there are two optimal points, okay? Two optimal points. The left side, there is a declining relationship, a negative relationship, okay? And the right side, there is a positive relationship. So when it is low, as in, let's say the minimum low, performance is high because the language used between the chairman and the CEO is different, suggesting independent monitoring. When it is high on the other side of the U shape, instead of independent monitoring now, the story is that stewardship theory prevails. There is alignment between the chairman and the CEO. So they are not competing with each other. There is strategic alignment. So there is also an alignment in their language use.
Okay. So I think I now understand more about those conclusions. So let me open the floor. So Jaideep, you are the first hand, and then we have Sunat, please. Yeah. Jaideep, please. Yeah.
Thanks. Hong. Really great work, Tolu. It looks like really promising some advances. Just a couple of clarifications and that I think will be like important in the next steps. So, firstly, what do you do about negative age gaps?
Negative.
Yeah. So, for example, what if the chair is younger than the CEO? For example, the owner of the majority shareholder.
Now I get your point. In few cases, the CEO is older than the chair.
Yes.
Okay. But the CEO has to be 20 years older. The difference between them has to be 20 years. So whether the CEO is older than the chair or the chair is older than the CEO, the difference has to be 20. I also use the real difference between their ages. So instead of using the threshold of 20, I use the continuous variable, okay, being the difference in their ages. And I uncovered the same relationship.
Okay, that's good. I think that's important to highlight because there could be some dynamics here which are different because like when the CEO is older than the chair, it's possible the chair is more powerful. So it's like it's an interesting thing to like look at as a subsample if you have enough data. The other thing I wanted to ask about was about this stewardship theory interpretation. So why is stewardship suddenly more important at the end, at one extreme, compared to like maximal capture? So how do you distinguish between maximal capture, whereas like basically they have to be identical in their what they say potentially? Why is it that there's a sort of a continuum and then it just switches over to stewardship at the end? Uh, so that's something that you need to sort of like try to discriminate.
Yeah. So what you are suggesting is that the similarity in their language may not be alignment. It could be capture. Is that what you are suggesting?
Yes. I mean that is the case anyway, isn't it? So I mean, but the only question is why it probably is like that up to a point, but when it gets to the maximum point where like you have the highest level of similarity, then you interpret it as stewardship, but not before, which is a little bit difficult to sort of be clear about because you should be able to discriminate between capture even at that point and stewardship.
Okay.
So that's a. I mean, that'll be a consideration. For example, uh, there if you look at past performance of the CEO, and they're doing really well, they basically have full charge of what the strategic direction of the organization is, including like which who the chair is, and so they could easily sort of fully capture that, and the past performance will predict future performance and you'll find a positive relationship, although it's basically 100% capture. So that's the alternative story. Okay. I mean, at the right end of this U curve.
Mm-hmm. Okay.
Good discussion. And Jaideep, do you still have more?
No, that was it.
Okay,
I just wanted to
great.
question and a comment.
Yeah, thank you. I have I have two questions. Maybe I can use this gap. So first of all, yes, your key conclusion is the U shape. I was thinking about how do we theoretically explain this U shape? Maybe that is related to Jaideep's question about why you suddenly changed the theory. So I think I'm still confused about normally, yes, if you have a U theory, then you should explain what theory, U-shape, what theory determines this U-shape, or why which section is dominated by one theory and the other section is dominated by another one.
Maybe I did not make myself clear. Okay, there's a tension. Okay, and this tension is well established in corporate governance. Whether we should assume that the executives act in the best interest of the organization, in which case monitoring should be minimal, which is consistent with stewardship. Okay, and the other end of the spectrum, whether executives act in their own best interest, and monitoring should help to mitigate this, and that is your agency theory. So there's always a tension between agency theory and stewardship. And the same applies here. At one end of the U-shape, agency theory, okay, is dominant, where monitoring is independent. The chairman can act, okay, independently of the CEO. And this independent monitoring is reflected in the language, low similarity, okay?
Yeah.
And the other end of the spectrum, we have the stewardship, high similarity, okay? Alignment between...
Can I talk now?
Yeah.
Comments?
Yeah,
Okay.
so that we were waiting for you. Can you wait for another 1 minute, please?
It's all fine.
I will invite you to the floor then. So continue, Tulu, please finish your...
Then we have alignment. And this alignment is also reflected in the similarity of narratives. We also have the so-called danger zone, where we cannot distinguish between agency theory and stewardship. That is the turning point of the graph. So there is a tension between the theories.
So the combination, it depends on the level of the similarity and then which one is dominating the other
That is it. It depends on the level of similarities.
Yeah. Great. So Shulet, welcome back, Shulet.
Okay, thank you so much, Professor, for the opportunity and Tulos for this wonderful presentation. Mine are about 3 issues. One is related to the theoretical usage. You brought in the agency, stewardship, and role theories in the study of chair-CEO narrative convergence. But in my view, because we know that normally the chair of the board is more to do with strategic matters and strategic choices, I think it would have also been imperative to use the upper echelon theory, which upper echelon theory brings in more to do with strategic choices and performance, which are a reflection of what the boards do and the direction they give to these organizations. But when we omit that upper echelon theory, yet we are dealing with the chair who represents the board, then maybe we miss out a key distinct or a key joint. And in the same vein, when you have both agency and stewardship theory, they may not augur well to be used in the same study, especially the 2 agency and stewardship. Probably, stewardship would work to replace agency, and maybe you bring in the component of the upper echelon theory. Of course, like what Professor Hong had alluded to at first, the chair represents shareholders because agency theory is more to do with shareholder and management issue. When your response was the chair represents the shareholders, but the aspect doesn't come out clearly. Well, you will find in some organizations, the chairpersons of these boards are not necessarily shareholders. In some cases, when you look at the new event in corporate management, so I think now agency becomes questionable. Now, similar, the other issue is on the gap. When you came up with the hypothesis 2, your distinct was on age gap between the chair and the board. And my preposition there is some of these positions have specifications, and one is to do with age. You should not be below or above this age. I don't know whether it reigns supreme here. But in my view, I would think from the practicing point of view that the chair and the CEO could be boxed in a corner based on the qualification. It is this qualification that normally scares away or brings in that cohesion or convergence or divergence, if I may use that concave convex kind of convergence and divergence. I think it is more to do with qualification. For example, if a professor is the CEO of a company and the chair is just a degree holder, this chair will fear a professor in some aspects to monitor him. But age, this one is 40, this is 50. I don't see the monitoring aspect really coming out where I am using a practicing point of view and then, of course, academia and logic here now. My thing is to think about adding maybe the issue of qualification to make your study more important and informative. Then lastly, also to think about I have looked at the models you have specified, and I was trying to link the specified models to the theories you used. The theories were very good, but how now they link to the models you specified, I see a very big disconnect. How do the theories inform the models you specified? But also think about having a theoretical model that would inform your specified models. That is it from me. Thank you.
Yes.
Thank you very much, Tulu.
Yeah, thank you, Juliet. The first issue that you raised relating to upper echelon theory, actually, that is not the foundation of the paper, but I also applied it. In fact, the upper echelon theory relates more to the management team, the executive management team. The fact that their personal characteristics affect outcomes. I applied that theory to some extent when I was looking at age, but it is not the foundation. It is not the foundation of the paper, because I do not, in the first place, it does not really relate to the characteristics of the board members, even though some studies use it, but specifically it relates to characteristics of executives. So I did not rely on that theory, okay, primarily to motivate the hypothesis. But to some extent, when I looked at the gap, I introduced the theory. In terms of the link between the theories and the econometric models, I do believe that I may be wrong, and I appreciate your comment. I do believe that the link, in the sense that the agency theory predicts the left-hand side of the U-shape, okay? And the stewardship theory predicts the right-hand side. But again, I will look more into the theory and see how I can reconcile the findings and incorporate your suggestions.
Okay. Yes. So you happy and for so Yeah. Whether or not there are two other issues from Shulet. So whether or not the chair is really representative of the whole shareholders, and the other one is the age gap. So I also have a question on the age gap. So I think it's a very good idea to check those moderating effects. But if I was the referee of this paper, I would ask the question as the following: why did you choose the age gap rather than gender gap? Gender, for example, or cultural gap, education gap. So if you have the characteristics of both CEOs and the chairman, you can do quite a lot of check. Why did you use age gap only? So that's my first question. My second question is on your performance indicator. So we do a lot of firms, you and me, we also do the firms. So ROA is only one of different multiple performance indicators. Why did you choose the ROA, for example, rather than choose stock market performance? So I think if I see the report, if I know your research, I will follow the company's disclosure. I see the differences between the CEO and the chair. I will do something immediately on the stock market rather than ROA, because ROA will take time. Maybe next year you will see the reaction. So I will ask those two questions. Why did you choose age gap rather than other diversities indicators? And then why did you choose ROA rather than other performance indicators?
The first question in terms of other diversity indicators. The issue is that if you look at the typical FTSE 350 firms, it will be difficult for you to see large enough CEOs or chairs that are female. Even though in the regression, you see that I control for female. But in terms of CEO chairs or female CEOs or female chairs, we have limited number there on FTSE 350. So that may constrain the data. But I can look at the data again and see whether gender can actually moderate the relationship. In terms of age, many studies have actually looked at the implication of age gap. There is this study, Mind the Gap. Okay, I've forgotten the author now. It introduces the idea that age, which could be, for example, a proxy for risk. Okay, it could be a proxy for risk because we believe that older executive or chair are less risk averse. Sorry, are more risk averse. Okay, so it could be a proxy for experience. It could be a proxy for many demographic variables. So that was why I went for age gap, and I motivated. Even though this is not the fully developed paper, I motivated the use of age gap in the model. We have also seen papers working on the implication of CEO power. Okay, although it is difficult to measure CEO power because the power comes from a number of sources. I've only captured 3, given the data that I have. But we have seen papers looking at the CEO powers, entrenchment papers, for example. Okay, how entrenched the CEO is and the impact on performance. So that was why I also used this CEO power as a moderator. Of course, there are also additional moderators that I can explore. I will look at the data again and see if this is possible.
About firm performance indicator?
Yes, I actually use Tobin skew. I used Tobin skew, but it didn't come out well. To be honest, there was no significant relationship when I used Tobin skew. Although I use it as a control variable to measure growth opportunity, but when I use it as a dependent variable, it didn't come out significant. I could explore the use of return on sales as another measure.
Yeah, but the thing is, firm performance is a multiple aspects, measurement.
Yeah.
So people will ask you to check the robustness by using another one, etc., etc.
Yeah, I appreciate that. That was why I tried to adjust the baseline return on assets to see if the results will change if we use industrial return on assets. But I used Tobin skew, but the values were not significant. And probably journals don't like to publish insignificant results.
Yeah, but you can use the stock market return data rather than Tobin skew data. Tobin skew is constructed. So but that's the logic. So what do we have from colleagues here? Do we still have more questions? No? Okay. Oh, we do have one. Jeffrey, please. Yeah.
Yes. Thank you, Tolu, for your presentation. I just wanted to say something about the age gap as well, because what I find interesting is the fact that power wasn't as strong as age gap, because power, and which is sort of related to what Sulite was saying earlier, qualification, power, those are usually the dominant variables in the literature when it comes to this. So the fact that age gap is the dominant variable. So I'm thinking whether it's related to cultural issue, because you look at it this way. In many cases, we have issues where some cultures respect elderly people a lot, whether they are less qualified or more qualified. So I think these are cultural, this could be sort of related to cultural things that define that age gap, rather than, because otherwise it becomes difficult to really back it up theoretically. Why is age gap so significant? Which is what I think is somehow related to. It would be related to culture, which is where that drive is coming from. And this is not new, because we have studies that have used the so-called Hofstede's cultural dimensions, which is very popular too, because it shows how cultural dimension can shape the corporate governance. So I just wanted to add that cultural thing, if it's possible for you to explore that a little further, why age gap is so significant, looking at cultural side of things, using that Hofstede's cultural dimensions measure as well. Thank you.
Yeah, thank you, Jeffrey. I think that's one. The study is based on UK data. Okay.
Oh.
Yeah, it is based on a single country data.
Yeah.
So,
but not necessarily all UK people who are the CEOs. I mean,
Yes.
maybe Indian, maybe Chinese, maybe So the cultural background is different.
Yeah,
I'm sure.
Cultural background of CEO versus the cultural background of chairman. These are people from different backgrounds. Are these people coming from, like Hong just said, China? Is this one coming from Ghana? Or if possible, maybe you want to do some sort of comparison, look for position another country, do a bit of selection and compare with these firms in UK if you want to stick to strictly national base, and see whether, because I'm thinking there must be a role for cultural dimension here. That's why, to find a way to explain the role of age gap, I think explaining it like how mentioned John already. So you will need some sort of explanation for that. I think if you look into that deeper, you may find one.
Okay. Yeah,
Jeffrey got the chance to revenge. Yeah,
no,
Jeffrey was. You were the second supervisor some time
okay.
ago.
Yeah,
I
have their nationality data, to be honest. I have the nationality data. I'll see what I can do with the data. Yeah. But usually this cultural something is mooted when it comes to the UK and when it comes to a single country study. But I will look at the nationality data.
Yeah, because if you stick to the UK narrative, I think that makes it even more difficult, because thinking that, okay, in the UK, cultural dimension will not be important, I think that sort of also make it more questionable. Okay, if culture is not important, how do you explain the age gap? So, okay, if you don't want to use the age gap, maybe you find other explanation that sort of cement this with the result. But I'm thinking, like Hong suggested, the background of the people, maybe that will help.
But I do agree. Age diversity is an element of diversity of the team, and there is a theory about why diversity is beneficial for corporate governance. Yeah. So I think there's nothing wrong with the age gap, but there are more aspects of the diversity. So the question is, yes, why only age? And if age represents many other things, it's more difficult to interpret which exactly the factor that is taking effect. So, but we got the logic. We want to ask whether we have more comments and questions. Jeffrey, thank you for the question. And do we have more? Very good. So, Tulu, I think we had a very constructive session today. Your presentation was very clear. As always, very simple but clear and concise. So, and I see that there are some the selling point probably is on the construction of the convergence indicator and using the large language models, etc. So I think that is nice, but there is a lot of opportunities to check different things if you want to make this paper more, more sophisticated, let's say. So, very good session, and it's a very good topic, and that allows a lot of different thinking, actually. And Tulu, before I close the session, I gave you maybe 1 or 2 sentences to conclude.
Yes, I would say a big thank you for the opportunity to present this platform. And perhaps more importantly, the time that you have committed. I know everybody is very busy, especially at this time. And this is almost 2 hours that we've been together. I want to say a very big thank you. I will look at each and every comment that you have made and try to incorporate them as much as possible to improve the quality of the paper. Once again, thanks a lot.
Yeah. Thank you very much, Tulu, for your time, for your commitment, and for updating us your research. Very nice. And thanks everybody for being here with us and for your questions, contributions to the discussion.